Here's something almost nobody in the retail trading world knows. Big institutions don't just watch the market, they control it. And they do it in a way that most traders don't even realize. So stick with me for the next 4 minutes and I'll show you exactly how. In the most major indexes like Nifty 50, S&P, Nasdaq, Bank Nifty, Sensex, the top 5 stocks often determine the most of the index movement. The stocks with the more amount of market cap controls how much they have weightage in the index. So for example, right now Reliance controls the most amount of weightage, then HDFC, and then there is another one, Airtel, I think. So this means if you can control the price of these few stocks, you can basically control the index itself. If you can control where Reliance goes, you basically control where Nifty goes. And this is exactly how I predicted market manipulation about a few weeks ago, where I saw about all the stocks in Nifty 50 were falling, but the index was moving up only because Reliance was moving up and the other main stocks were flat. So at that point, I realized it was a trap. So I didn't get into a bullish position, and that's how I avoided that. But now, so what do institutions do? They push these high weighted stocks into tight ranges. So if I show you about a few high weighted stocks right now, so right now the top 5 stocks: Reliance, HDFC, Bharti Airtel, and TCS and ICICI. So these 5 stocks are the most controlling in the Nifty index, and wherever these 5 stocks go, that's where Nifty will go. So for example, if Reliance is going up, Nifty will go up. HDFC goes up, Nifty will go up. So as you can see, so out of these 5 stocks today, about majority of them were green, and even outside the 50 range, majority of stocks were green. So that's why Nifty moved up. But usually, what happens on manipulation days, it's always one stock that goes up. For example, it's Reliance. So if I go to the Reliance chart, so see this chart. It's like pure manipulation. They put DIIs. Main things are like the DIIs. They keep buying stocks like HDFC and Reliance, and that keeps pushing the market up. For example, Reliance today is up about 3%. That is a lot. That is actually a lot for the top stock, but Nifty is only 0.42%. Nifty should be at least 1% by the weightage, but why? Because HDFC fell, and now HDFC fell, that counteracted the movement. So that got the market sideways, and today it was the Sensex expiry as well. So they burnt off the premium. So this is the main point. Now this lines up with the exact point that I want to tell you. So after these, institutions, once they keep these stocks in a range, for example, they keep Reliance in a range of 1200 to 1250, for example, by the way, retail traders see that and see the index is completely sideways, it's a boring market, they leave. But that is exactly what institutions are doing. They are carefully pinning the index exactly where they want the index to stay in a range bound market because they have sold options. They are trying to burn off the OTM premiums by taking all the money from the OTM strikes by pinning the index somewhere. And it doesn't even get noticed really easily because they spread it across multiple expiries, sorry, multiple options. So they don't just short 24,800 all at once. Like there is institution who will short like 2 lakh contracts of this particular strike. They will spread it across multiple strikes. They will go 800, 750, 700, 650. For example, they will do like this. They will spread it across multiple strikes, so that doesn't even get noticed really fast. But once institutions have sold these options and the premium burns off, retail traders who bought them, they lose money. And because the price movement is controlled by the top stocks, they can engineer this outcome predictably. That is exactly what Jane Street did. It was however a bit more advanced than this, but it's overall what they did. Because in India, FNO volume is about 300 times more than cash market volume. Cash market can be manipulated easily, FNO cannot. And retail traders also barely notice this because of 3 main reasons. First of all, the move is small and it is spread across multiple trades, and most traders don't track index weighting or derivatives mechanics, so they don't know that index can be pinned on certain levels. Third, even if they notice, they don't connect it via manipulation. If they might see it sideways and go like, okay, the market is just sideways and boring. The market is not sideways. It's sideways because someone wants it to be sideways. And that is exactly what you should do as an option seller. You should follow the institutions. If they are shorting, you should also short. Why are you following retailers? If every retailer is bullish, then who will lose money? Then who will make money? If everyone is like on one side of the trade, then who will make money? That's the key thing, right? And on your screen right now, you can see a chart which shows the highest weightage of the few stocks in the Nifty 50 index. These things cannot be faked. And another thing, index can also be engineered with futures. However, using futures is extremely hard because future is in the F&O segment, and futures is used by every institution to hedge, not just speculate. So yeah, it's mostly cash market. But for example, Nifty futures, and it's normally the current future. Like right now, the current future is this one, 28 August. So they can manipulate the prices of these futures, and the market making algorithms or the HFTs will see an arbitrage. That means an arbitrage is nothing but the difference between a future and an index. So they might buy and sell futures to match the index. And if I really want to explain arbitrage to you, so basically, if futures right now is at 24,500, but index is at 25,000. Sorry, not 25,000, 24,550, let's assume. What they will do, the market making firms and the HFT firms, they will start shorting the stocks in the cash market, and that shorting will push down the index price itself. And yeah, that's how they match the arbitrage. It's like really advanced topic. I can't explain it in one YouTube video, but you can look into it. It's really fascinating if you get into these types of market mechanics. But yeah, that's all. So the result, retail buys options thinking they are betting on a big move that never comes. Even today, the market stayed in a range. It moved up, down. It stayed in a range. So the next time you trade options, remember the index might not be moving by accident. It's engineered. And knowing this can completely change how you approach trading. So this is something of a topic that you can apply directly into your trading strategy, but this is something that you can apply in your psychological side, because if you know the market is being manipulated, then you can better manage your positions. So if you found this video helpful, it was a really short video, then please do let me know.